Hi, this is Shad Ritchie, and today we're going to be talking about our assignment related to the capital equipment request and how to look at it in terms of return on investment, meaning when we anticipate we're going to be able to get full reimbursement of the equipment or pay off the equipment. So what I thought I would do today is go over an example with you so that you would be able to do something similar. And this is going to be something that you would do in a actual real world example if you are a healthcare administrator. Most of the time you're going to be taking a request to a capital committee or to a senior leader for approval of capital equipment. And as we discussed on our last class, capital equipment funds right now are at a premium for most organizations. And we know that because reimbursement is going down, costs are going up, and there's going to be more limited funds to request capital equipment in the future. I say that though, if you have a request that's going to generate revenue or more income for the organization, it's more likely that they will entertain spending capital funds on something that's going to generate revenue. So today I'm going to go over quickly an example of one that I've pulled together. This is pertinent to me in my current position. So you'll see at the top of the document, I have renamed the organization. You definitely can rename the organization whatever you would like. This is going to be Dermatology Group, Inc. And we have, this is the capital request form, return on investment. And what I'm going to be requesting, you'll see here in column B, row 5, is laser equipment purchase. And if you're familiar with dermatology, they do a lot of cosmetic work in some cases. And so a laser would be very beneficial in a dermatology group practice setting. So myself, Shad Ritchie, is going to be the project leader, so I put my name there. And then the total capital request that I'm going to be asking for is $150,000. And this is the cost of the full equipment for the laser, as well as any training on the equipment and any upfront costs related to medical supplies. So a full package. So $150,000 for the laser equipment. And the reason is this is going to allow dermatology to increase our cosmetic procedures and our revenue over time. Okay, when we're looking at the capital request, there's going to be a lot of information that we're going to need to think about when we're looking at it. We're going to have to look at the revenue, obviously, in the volume, and then we're going to have to look at expenses as well. That can include salaries for maybe new employees, some variable expenses, maybe some medical supplies, and obviously some fixed costs that are associated with this particular item that we are requesting. So then at the very end, it's going to help us. This particular document has formulas in it, so it's going to actually help us determine how quickly are we going to be able to pay off this capital equipment, which is ultimately what you're going to have to present to your capital committee. So let's get started with the revenue at the top. And I've already made some assumptions, and I've put those down below. So I'll be talking a little bit about those as we go along. But I've made some assumptions, and when you do this project, you'll do the same thing. You'll look at the type of equipment that you're asking for, and then also make some assumptions while you're doing it. And again, I am asking for $150,000. And so with this laser, what we are hoping to do is that in year one, since this is a relatively new type of procedure for this particular dermatology group, we are trying to estimate, being conservative, that we are going to do 4 procedures per day. And this particular piece of equipment is going to be able to do a lot of different things: hair removal, some skin rejuvenation, all those type of procedures that could be cash pay for cosmetic. So in this case, we're going to populate 4 procedures per day. What we are thinking is 2 in the morning and then 2 in the afternoon. So I'm going to put 4 there. So like I said, I'm putting 4 procedures per workday, 2 in the morning, 2 in the afternoon. So you will input that information there, and it should already have the decimal places there for you. Then in year 2, what we're going to assume is that our current clientele are going to tell others about it, or our current clientele will come back for more procedures. So we are estimating that in year 2, we're going to do 5 per day. And then year 3, we are going to do 6 per day, 7 per day in year 4, 8 per year, or I'm sorry, 8 per day in year 5. So that is going to be our estimation in terms of how many procedures per workday. Now what we do is we do some investigation on how much are we going to average, on average, charge for a procedure. So if you're familiar with lasers or you're familiar with whatever product you are, you want to do a lot of investigation to see that you're going to be competitive within the community for this particular piece of equipment. And so what we have researched is that for on average in year 1, we're going to estimate $400 per procedure. And you'll see that it already calculates for you with the formula that it should generate about $83,000 worth of revenue in year 1. Again, this is going to be cash pay clientele, so this we're going to capture those dollars up front rather than submitting for insurance. So that is not always the case in terms of medical equipment. So if you're asking for an ultrasound machine or an MRI or a CT machine or something like that, then obviously you're going to have to factor in some insurance-based write-offs based on that. Then in year 2, what we are going to estimate is that with inflation, that prices are probably going to go up, and we're going to average about $500 per procedure, then $600 per procedure in year 3, $700 in year 4, and year 5 is $800. Again, these are only projections to help us relay to the capital committee or executive leadership of what we think is going to happen. You'll see then that our income is going to go from $83,200 through year 5 to $332, and that's per year. So it goes $83,002, $130, $187, $254, and then $332 with a total of $998,000. And you'll see that when I click on the cell there where it says $83,200 in D18, you'll see at the very top where the formula, it is actually taking D16, which is 4 per day. We're multiplying that by 52 weeks in a given year times the average charge or collection per procedure. So that's how we get to that number, and that is already built in. If that's not going to be pertinent to you, you can adjust that formula. If you're not going to be open 52 weeks a year, then you may want to think about changing that formula. So now that we have talked about the revenue component and how much we anticipate this piece of equipment, in this case the laser, is going to generate, we need to think about how much expense is also going to be associated with this. And then the first part, we're going to look at employees or salaries needed. So in our case, the dermatology group already has clinical assistants, they have nurses on staff, they already have those type of individuals. What we are going to need is some sort of esthetician that's going to, a certified esthetician that's going to help us be able to operate this piece of equipment. So when it says non-nursing employees, you could think about putting it there. We are not going to need, in line 26, any nurses for this particular case. However, in your capital request, you may need a nurse. And then the last one is a tech assistant. So that's where I'm going to be putting that information. And on average, if you were to do some research, you would see an esthetician might make up to about $25 per hour. So I'm going to plug that in. It's going to automatically give us in year one, $25 per hour, but then in year two, we've added a 3% merit increase based on their performance. And assuming that that person's going to make a 3%, and through year five, it also gives a 3% each year. So, and then also in this, the spreadsheet, it's going to be required to identify how many do you think you're going to need, how many estheticians are we going to need in this particular capital request. So in year one, I think we're going to start with 4 because obviously one esthetician could handle 4 procedures a day. So we're going to put 1 in that column or in that row. And then in year 2, since we're adding volume, it may be wise for us to add another half a person in case somebody calls out. So we're going to put 1.5. And then we're going to keep that number to 1.5 each year thereafter, up until year 5. As we think we could probably get a total of 8 procedures per day with 1.5 individuals. What you'll see too that happened is that the calculation on the spreadsheet, then it automatically calculates what their annual salaries are going to be. And you'll see it goes $52,000 in year 1. That's because we are looking at 1 individual times $25. Then in year 2, it goes up quite a little bit significantly. And that's because we added a 0.5 of a FTE, and also the salary went up slightly. So it goes, it's calculating your salaries for you, as well as 25% for benefits. Obviously, these employees are going to get benefits, and so that calculates that for you as well. So you'll see that the total salary expenses there will equal $485,000 over a 5-year period. So that's quite significant when you're looking at the cost of the equipment, how much revenue you're going to generate, but then also expense is quite significant in this particular case. The next item that we're going to talk about is some variable expenses that you may need in order to operate your piece of equipment. So in this situation, we are going to have to utilize some extra medical supplies that we do not normally utilize today in the dermatology setting. So we're going to have to add some more supply costs when we're doing that. So what we've estimated is in year 1, we're going to need to get an additional $5,000 in supplies to operate the laser. In year 2, we're going to need to ask for $7,000. Year 3, we're going to ask for $9,000. Year 4, we're going to need to ask for $11,000. And then year 5, we're going to ask for $13,000. So you'll see that the variable expenses adds up to $45,000 over a 5-year period, and that could be conservative. Hopefully, we're not going to overspend based on that, because that will disrupt our calculation for the capital equipment. So the project cost, as we talked about, is going to be $150,000. So then what we have to do is we have to figure out a depreciation, or how long are we going to anticipate that this piece of equipment is going to survive. And lasers usually, they can last quite a while. I'm going to anticipate that we're going to use this laser for 10 years. That may or may not be appropriate given that technology changes quite often, but I'm just going to use a 10-year depreciation life. So when calculating the depreciation for a 10-year period, there's going to be a small little formula that we're going to have to input. And so I'm going to use a formula that's going to use an absolute number, which you may or may not be familiar with. It's just going to round it for us. And so I'm going to do an equals ABS for absolute. And I'm going to do a parentheses. And then I'm going to utilize this C45. So I'm going to click on that. And then I'm going to divide that by 10. That's going to give us $15,000 per year for depreciation. And if we want to pull that across over the 5-year period, again, if you remember from the last video, you can click on between C45. You can put dollar figures in front of the C and then after the C, and this is going to keep that cell constant as you move that across. So I have entered that information in. Again, you'll see it's absolute $C, $45 divided by 10, and then I'm just going to pull that across, and that's going to calculate the $15,000 for depreciation slash amortization for 10 years. Also, when we're looking at this piece of equipment, we're going to try to negotiate something with some sort of warranty. We're going to estimate, though, that it could be that if something's out of warranty or we do something to the machine that perhaps maybe it was our fault and it's not under warranty, then we're going to need to add some dollars for that. So in the first year, we're going to put $5,000 in for the warranty or service contract, $5,000 for hopefully year 2. So hopefully we won't need a lot of service in the first 2 years. Then we're going to increase that to $10,000 for the remaining 3 years. And I'm just going to pull that across. If you're familiar with Excel, you can just drag that across. The other components that you can look at, and these are not the only ones you have to look at, you can add others to this spreadsheet. In some cases, there's office supplies, maybe postage, maybe electricity, water, maybe environmental services if you're asking for some sort of radiology equipment that requires special type of liquids to be disposed of, other expenses, and then linen expenses. The only thing that I'm going to utilize today is linen expenses, because in dermatology, quite often you do have to undress for skin checks and let the physician be able to see you, but a lot of times you use linen gowns. And so we are going to increase that because we're increasing our volume. Not only are we going to keep our current volume, but we're now going to increase the volume. So for linen, I'm going to increase in year 1 to $1,500. Then in year 2, $1,750. Year 3, we're going to go to $2,000. Again, all of this is because our volume is going up, and this is just an estimation. And I think we can probably figure out that after that, we can probably have a cutoff point of about $2,000 for that as well. So that is just an assumption that I made. So you'll see that all of the fixed expenses then equals $124,250. So we have expenses of $485 for salaries for staff. We have $45,000 in medical supplies, and then now we have $124,250 in our fixed expenses. Total expenses then now equal $654,391 over a 5-year period. In order for us to even contemplate the capital piece of equipment. So this gets very detailed. So what I would suggest is that if you're not familiar with these type of spreadsheets or working with very detailed information, not necessarily for this exercise, but if you are going to actually perform this type of analysis and present to a capital committee, that you do work with someone in your financial department to help you make some of these estimated costs or revenue, and for revenue as well. So I would definitely encourage you to utilize your financial department as well. So like we just indicated, the total expense is going to be $654,000 over a 5-year period. It ranges from $91,000 to $149,000. And so what this line 59 for net income and loss does is that it identifies for us how much money are we going to be making off of this piece of equipment in year 1, year 2, 3, 4, and 5. You will see that in year 1, we are estimating a loss of $8,300. That is not uncommon when you're looking at pieces of equipment. Obviously, when you're buying a piece of equipment, it would be wonderful to be able to pay for it in 1 year or 2 years. A lot of times that does not happen, as in this case. And so your capital committee will most likely ask for a look back 3 to 4 years down the road to make sure that whatever decision is made, it actually is coming to fruition. Because what you don't want to do is, if your analysis is way off mark and you're spending way more money than what you did for the capital equipment, you may have to cut your losses then. But in this case, what you'll see is then in year 1, we're going to lose about $8,300. However, then in year 2, we're going to make about $825. Again, this is because our revenue is going up a little bit. Our volume is going up as well. Then in year 3, we're going to make $47,762 estimated. Year 4, $110. Year 5, $183. So total for the 5-year period is that we are going to make $333,609 when we're buying this piece of equipment and adding it to our dermatology practice. So in all, this is a positive projection, and it would allow us to have a good case to present to the capital committee that our spend of $150,000 is very valuable. And what I like to do to determine what year we're going to actually recoup all of our money is I take the 83,000, that's sales, so D59, and I hold down the left side of my mouse and I pull over, and down at the very bottom right hand corner, you will see that it's automatically summing for you. So right now you'll see if I click those two cells together, it's a negative 74.75, but then it's at 40,287. And then in year 4, if you add those up together, then it's going to be 150,546. And then obviously if you hold all those together, down at the very, very bottom of the screen, you'll see that the sum is the same as in I-59 is 333,609. So again, I go back to this because this is going to tell us when we think we're going to pay for the piece of equipment. So if you're going across, you're looking at the sum at the very bottom, then what we anticipate is by year 4, we are going to have paid for this piece of equipment, because the total sum of our net income is going to be $150,000, and we would have paid for the piece of equipment. Given that I have estimated the life of the piece of equipment being 10 years, then that would be very valuable for the organization to invest $150,000 in order to continue to increase volume and revenue based on this new piece of equipment. Finally, in some cases, some organizations will want to look at the annual cash flow. And so in year 0, you're actually going to start with the $150,000. And then what we do is we take, and I'll do the formula button here, is it takes the net income, in this case in year 1, a negative $8,300, and adds back the depreciation. Because you've actually already paid for the piece of equipment, you're going to add back that depreciation number. And so you'll see, and this is the same formula throughout years 1 and 5 through 5, that it's going to be 6,700 in year 1 and on up to 198 in year 5. Again, down below, you can make your assumptions, which I have done already. This is going to be very valuable whenever you are actually showing your information to capital committee or a financial advisor that you have done your due diligence to make the appropriate assumptions and that everything looks adequate. They will probably most likely want to know, are you being conservative or are you being very aggressive in your calculations? So with that said, this is a quick example of how to do a capital equipment request. Look at how many years is it going to take to get your return on your investment if you spend $150,000 or whatever your particular one is going to be. And this is the assignment that I would like for you to complete, is to actually do a 5-year pro forma analysis. And then on a separate document, a Word document, no more than 1 page, an executive summary, as if you are going to be delivering this to a capital committee or a senior level management, that you're going to give a synopsis of why you feel this piece of equipment is very important, what you estimate in terms of volume and expenses, and then at the very end, summarize what it's going to do for the practice in terms of overall revenue and volume generation. So that's going to be the assignment for this period of time. And if you do have any questions, please do not hesitate to reach out to me. And hopefully this video was helpful. Thank you very much.